Welcome to EmFi, Embedded Finance in Africa, a Renew Capital series exploring how technology, capital, and entrepreneurship are transforming financial services across the continent. In each episode, we sit down with founders, operators, investors, and industry leaders building the products, infrastructure, and financial systems that serve millions of Africans. Our goal is simple: learn from the people doing the work and share those lessons with the next generation of builders. We're grateful for the support of Global Affairs Canada, NORAD, and the Government of Morocco. Now, here's today's conversation.
Good afternoon, everybody. Thank you for joining us, and welcome to the second of our conversations in this EmFi series that Renew Capital is hosting, where we get to speak with exceptional leaders in the world, and specifically in Africa, that are leading in the space of embedded finance. My name is Adam Abate. I lead investments for Renew Capital, and I'm going to be your host today. The purpose of these sessions is really for us to engage in some amazing conversations with people who have lived this embedded finance story on the continent. Before I jump into our conversation today, just a couple of housekeeping items. The conversation will go on for about 45 minutes, and then the last 15 minutes we'll leave open to questions from the room. Please drop your questions in the Q&A section on Zoom. I know there's also a chat section. Please use the Q&A section. Our team will pick up the questions and then feed them to me in the second half of the session, and I will be able to relay those to our guests. If you can, please include the country you're calling in from. I know we have people joining us from all over Africa, so it's interesting and exciting to see where you all are calling in from. I won't get to everybody's questions, but we'll try to get through as many as possible. And now, with that said, I have the honor today of being able to speak with and have you all listen in to a conversation with Mohammed Okasha. He's also told me that he likes to be called, or he goes by Okasha, so that's what we'll call him today. Very briefly, before I turn it over to him, Mohammed was the co-founder and managing director at Fawry, which, as many of you know, is one of Egypt's largest digital payments and embedded finance platforms. He was part of the founding team that built Fawry from a bill payment startup in 2008 into Egypt's first tech unicorn, overseeing its growth to over 50 million users, over 300,000 plus agent points, and culminating in its landmark IPO in 2019 on the Egyptian exchange. I believe this was one of the first fintech listings in Egypt's history. And just out of curiosity, I quickly looked on the stock exchange at the valuation today, and it seems to be trading at a market capitalization of around 1.3 billion US dollars. Okasha is now a managing partner at Disrupt Tech Ventures, which is a leading Egyptian early stage venture fund. And we'll get into a lot more about his thesis and his vision as he leads this fund across Egypt and across the region. So Mohammed, Okasha, thank you so much for being with us, for giving us your time. It's a real treat, and I'm really looking forward to chatting with you today.
Thank you, Adam, for having me, and thank you for the kind introduction. Thank you for the kind words, and it will be a compliment. Thank you. Great. Glad to be here with you.
Yeah. So, Okasha, I always like to start with a little bit of the human behind the big headlines. So, would you mind perhaps telling us a little bit about yourself personally? Where did your journey start, and where do you find yourself now?
Okay, thank you for this. I come from an IT and telecom background, so I started my career in the biggest system integrator and IT provider in Egypt, actually a company that was working in the region. And then in 2006, I joined Vodafone as head of marketing. And that was an interesting part because during my time in Vodafone, I had the luxury of being exposed to many mobile money initiatives across the Vodafone operating company, mainly in Africa, in Kenya, and some in the Gulf as well. So in 2009, with a couple of my colleagues, we came to the conclusion that we wanted to do something around payments. And we started the journey with Fowry in 2009. That is quite an interesting journey that ended in 2019, as you mentioned, with listing the company in the Egyptian Stock Exchange. 6 months after that, I decided to step down from my position at that time as a managing director of the company to start a venture fund. That happened in April 2020, exactly in the core of the COVID time. I was more encouraged to start doing this fund because I felt that the digital transformation and the digital payments will see a hype, and I wanted to be part of this new era. Disruptech Fund, as you mentioned, is as an early stage fund. We invest very early pre-seed and seed. We focus on startups that have a fintech or fintech enabled thesis. We invest mainly in Egypt, and we invest selectively in Africa. So recently we have done a couple of transactions in Morocco and another transaction in Nigeria. Lately, last year, we thought that it is also important for us to expose ourselves to AI. So we made a few interesting AI investments, mainly companies who are founded by Egyptians who are building either a regional or a global product. We invested 25 startups. So far, the fund is almost deployed. So we are in the last year of our fund one.
Excellent. And could you elaborate a little bit on your investment thesis with DisrupTech? I know you said fintech, but are there any more specifics, and what's your thesis behind the fund?
I mean, we believe that we have a specific industry expertise that we can really help the early stage startups to build a fintech play. So we said that this is the focus, this is the stage that we wanted to do. And we believe that the companies in the first 18 months of their life, they need more than the money, they need coaching and guidance. So playing this role will add a lot of value. So we have successfully managed to establish ourselves as a value-add investor, where most of the startups that we invested with helped them in the very early time to land on the right strategy, avoid some mistakes, do some things right. And we believe that this have helped few of our startups to really take it to the next level. When I mean fintech and fintech enable, these are two. The fintech is clear. I mean, something that is mainly regulated and is pure fintech play, either in payment, saving, lending, insurance, and other plays where we believe that the fintech is playing a role to disrupt an industry like agriculture, like education, like pharma, industries that have been traditional for a long time, and the fintech as an embedded finance can play a great role in transforming this industry. So these are the ones that we did. In Africa, we are very selective in investment. I mean, we invest in companies where we have done the same business model in Egypt, because Egypt is a bit advanced in some sectors, big population, big market, very much exposed to Europe and to the Gulf. So there are things that we have done in Egypt that we think that the African countries can benefit from the learnings and know-how that we did. So that's basically our thesis. We are a small fund. We are at $36 million. So that's why our check is very small. But we think that combined with the value, we are very close to the companies and the founders that we invest with.
Very clear. Okay, so it's not often that we get to hear the backstory behind one of Africa's major successes. So if you don't mind, I'm going to jump into the Fowry story a little bit. And my first question to you was, you started with bill payments at corner stores. At what point did you realize that Fowry was becoming something much bigger than just a utility payment network?
Actually, you will be surprised when I tell you that from day one, even that we started even before bill payment with an air top-up distribution. So we built an agent network that the first use case was selling airtime. Uh, Scratch card at that point in time was common, and people were that was the main way to get an airtime top-up. So we were the part of the wave to change that to electronic top-up, and we established a network with the first use case built around that. Then we added bill payment. But from day one, we had the clarity, even to our first pitch to investors, that we are building an infrastructure for Egypt. We believed that Egypt, with the current structure, has a lot of pluses, but have banking limitations. I mean, the banking infrastructure that has been built is being built to serve the 10% of the society who have a bank account and exposed to the banking services and digital services offered by bank. Egypt, by the way, was very advanced in the banking. I mean, most of the banks have mobile banking very, very, very early on. They have IVR. They have a lot of digital services, ATMs, but they are serving part of the society. So we think, what about the other 90%? And these people needed what we call the human ATM. So the human ATM, we said that because of what I have seen in Kenya, what I have seen in Turkey, what I have seen in India, that the only way to do that is to equip the small kiosk to become a human ATM. So although that we started with a very basic use cases like top-up bill payment, but we had always in mind, and you can see that from day one, we provided our retailer with a full functional financial point of sale, not a mobile terminal like Kenya. We wanted a full function point of sale because we think always that there is a lot of value-added services that can be added later on to this merchant and be used for phase 2 and phase 3. Sometimes we went ahead of ourselves and we felt that we are going faster than the market needs. And sometimes the market was faster than us. We thought that this is, we would wait, but the market adoption was very fast. But you had always the same vision. I mean, this is an infrastructure. This is a platform for payment. The one thing that I think never changed, I mean, across the 10 years, is that our focus was, or our promise to the customers, so either a merchant or a consumer, is consolidation and convenience. Convenience, I mean, I want you to do financial service that you do in the most convenient way. If it is a store near your house, if it's a mobile app, if it is an ATM of the bank, or if you want to do it even on your home while sitting through a telephone call. And consolidation, I mean, I consolidate as many services. Currently, I think Fawry has more than 1,000 services offered through the channel. So as many services I consolidate, even the ones that are barely used, but still it constitutes a profile for the customer to find. So consolidation and convenience never changed, but the service kept on adding on.
Interesting. I found it interesting that you said sometimes you were ahead of yourself and sometimes the market pulled you. Could you give us a couple of examples? I thought that'd be really insightful.
Yeah, sometimes we felt that when we talk to the merchant and the profile, some of them cannot read and write. So we thought that it will be difficult for them to use a full function financial point of sale like the ones that the banks give to the Carrefour or top hypermarket. Surprisingly, when the customer or the merchant sees the value and sees this will bring him money, he finds a way to deal with it. So some of the merchants are, and you will be astonished when they see them memorizing the numbers that they have to do to reach service without having to read what is in the menu. So I mean, when you see the value, you are ready to do an effort to get to it. But if it is, no matter how much you make it simple for me, because it is not relevant. So that's an example of where the market was really pulling us to do things because they wanted what it's in. Other things, I mean, when we started to introduce, for example, card payment and acceptance to the merchant, and because of the number of cards in the hand of people, and because of the commission structure that the card system is built on, like the merchant take rate, the resistance was too much that it took us years until we reached a point where the COVID was the catalyst for this to rocket. But I mean, before that, we were just pushing the market to accept. Again, saying that it was a great idea is that when we were ready, but when the market had an instance that required infrastructure to be there, you were there to capture that opportunity. So that's why we think sometimes is you be ready and wait. Don't rush the market to a place where it is not ready to take yourself.
Excellent. So perhaps maybe the shift, I got it incorrectly first. It wasn't, from bill payments to payments. Maybe the bigger shift was moving beyond payments into other financial services, such as lending and insurance and savings. You eventually moved in that direction. What would you say was the hardest part of that transition? Was it like a product problem? Was it a cultural one? Or what was that transition like? And was that always part of your plans?
I can give you an answer to question, not necessarily with Fawry, because Fawry reached that point very late in the development. But from the portfolio that we had in the Surtech, I mean, the shift is always difficult because it's a completely different DNA. I always say that each company has a DNA. I mean, you are very good in payment, you are very good in trading, you are very good in whatever you do. This is the company DNA that was built on it. Some people call it culture, but I would love to say it's more deeper than this. It's more of the company DNA in terms of resources, capabilities, processes, everything. When you move from something to something else, you are challenged because you don't have the capabilities, don't have the organization to support you. So it is not like people think it is easy. It's a cross sell and upsell. I have the customer, I have the brand, and I have the trust. So why not to offer another thing? No, you have to really think about it. As I tell you now, it is a different DNA. It's a different capabilities. It's a different team. And moving from one place to another needs everything to be restructured and changed to accommodate for that. Some stuff that we don't have to change. Most of our startup did not have to change. I mean, you have maybe a unified customer experience, customer relationship like call center. That's easy, but the operation and the back office and the way you service your customer for the second product needs a complete change. It's not a feature. It's more of a complete new organization within your organization. Yani, I can tell you a story. I mean, lending is different than savings. I mean, lending is maybe it's easy, but it requires a lot of, I would say, credit scoring, risk assessment, things that you were not thinking about when you do payment. If you look at insurance in our part of the world, in most of the Africa, it is sold, not bought. So you need to create use cases for people to adopt it. If you look at saving from the other side, I mean, there is an element of trust. I mean, how can you make the customer trust you with their saving, with their money? It takes a lot of, I would say, changes, even in the perception of the customer to your organization.
There are so many insights there. I'm writing furiously. It's really interesting. So did you live this at Fawry?
Yes, I mean, the changes in Fawry happened through a different stage. So, I mean, for example, the payment was there for the first 5 years or so.
Yeah.
But in the later second part of the life, we introduced a lot of lending, savings, and insurance. But it was not a big thing. It started to be a big thing after after I left, because the focus was growing the payment network and being the dominant player in that space. In other startups that we invested in DisruptTech, yes, we have seen this change happening exactly as I told you.
Really interesting. I'm sure there'll be a lot of questions maybe afterwards on some of the DNA and the culture differences between, the payments and then the financial services. And even every financial service is not the same. So each one will require. Very interesting. Let me move on now a little bit to data. A lot of, and even when you said when you describe the types of companies you invest in, I think you said fintech enabled. You mentioned some sectors such as agriculture. So I imagine that means companies that are working in different sectors, in different verticals that are gathering a lot of data that could become bankable. So my question is, when you look at some of these, and they're probably typically SaaS companies that are sitting on a lot of transaction data, what do you think most of them get wrong when they try to add a financial layer?
So, I mean, that's exactly the point that I was referring to before. I mean, data is very crucial. I mean, we usually advise our startups and the people who, when we meet to get investment from us, I mean, balance sheet business is challenging unless you have, one, the capabilities to raise a local debt, because you have backing and you have something, a way to raise a local debt from local institutions or local financial institutions. That's one way. The other thing is being able to use the data that you have to have a better assessment and credit scoring for your customers, and that would lead to a quicker way to give your customer lending or what they need in a better way. Building on that, I mean, a lot of SaaS has a great, or I would say, startups who have built their solutions and accumulated a lot of data. They have a great asset. They have a treasure. But again, to move to any of the other services, you need to build the capability of the organization to deal with the service, the new service, as it requires, because data on itself is not enough. How to use the data to offer it in the right to the right customer within your base and monetize the data in the right way. So we have seen it happening that some of these similar startups have developed a GP with the someone who understands the financial services very well, so they can come in this GP with the data, and the other come with an operation know-how. Sometimes when you try to use the data and offer financial services, thinking it is simple, the failure rate is high. No, putting in mind that the financial services in our markets is highly regulated as well, and navigating through the regulation is something that needs an experience as well. I always share this. Sometimes it is important to understand what and how and when to say the regulator what you want, because sometimes you say the right thing but in the wrong time, or in the wrong way. So you end up with getting a rejection, and that needs a lot of experience. Again, in our markets, there is what we call legal, illegal, and gray. As long as you're not doing something illegal, there is always a lot of space to play in the gray areas until things scale, and automatically the regulator will call you to say, let's sit down and find a way to make it compliant or build the regulation around the model that is successful.
Really interesting. So I know you also come from a technical background. If I just stay on that question of data, is there, early founders that are beginning to think about this, is there anything you advise on the data strategy? I mean, it's one thing to interact and collect a lot of data, but is there anything you might add about how that data might be structured and prepared to be useful?
That's a very interesting question. I mean, I'll tell you what we have seen. I mean, throughout the two last decades, there was a lot of business intelligence tools that can really take the data that you have and give you an advice or support your decision. So there was a lot of decision support systems that reads the data and give it. But it was not happening in real time. It was mainly something that you can read to shape your strategy, to readjust parts of your operational tactics. Now, with the AI available in the market, when the AI tools is developing, it gives you two things. One is that you can act instantly and becomes part of your operation daily, that you react to the data change. Second most important thing is that you move the data from the recommendation to an execution. So now we have seen in some of our startups as well, people who are building tools or using the tools to make it to make an AI agent that takes the data and embed it into the operational of the business, so it becomes an executable part. So you don't just get a recommendation, but it actually goes and executes some things in the middle. So you end up with a much better, efficient, and cost-effective operation.
Very interesting. Moving on to a slightly different topic, collections is a big part of a lending business. Some people might argue it is what a lending business is, right? And I know that in low documentation markets, this could be notoriously hard. What systems and behaviors did Fowry build early that made the difference in this? And what lessons maybe did you learn along the way?
Okay. I'll say this happened in Fowry and also in many of our lending business. Okay. There are two types of lending. Okay. There are long-term, what I say, long tenor lending products that requires that you have a collateral of a certain type. Okay. And that falls into the traditional microfinance and the traditional loans from banks. And that's typically has the same challenges that the rest of the market has in terms of collection approach. But what we did brilliantly in many of our startup is building the collection as part of the business workflow. So if I am giving you a lending, first of all, it has to be short term. So it is very close that you can monitor the cash flow of the company or the business or the retailer and ensure that it matches the cash flow. Second is that if I manage to collect from the same terminal that I am recharging every week or every day or every time to do a daily transaction, so I have access to the funding, and it is going to be very hard for the merchant not to pay because he will lose his business or he'll be out of business for a while. So that the risk of being not a good payer means that I'm going to lose business against that. So it's become the penalty is embedded within the system. So very important to do that. I mean, I can refer also to an experience that I had in Vodafone that we launched a service very common in other African market called advanced credit. So it is more of a service that the prepaid user can ask for credit if he run out of balance, and he can repay it back at the first recharge. When we launched it, we were under the impression at that point in time that the collection or the payment rate were very bad. We want to keep that because people can throw the line, and the lines are very cheap. Surprisingly, when you go to the math, the majority of people don't have the intention not to repay back. On the contrary, they have the intention to pay back, but they need it to be in a simple way and to be part of the normal practices. I mean, I pay back when I recharge again. So it doesn't happen in 2 days, in 3 days, in 4 days, but once I charge, you cut, you deduct. And that's the same approach that we took it to Fowry, took it to other startups. I mean, I deduct the next time you put money in the machine that you have to put money because you are using this balance for something else. So building the collection within the cash flow of the business, either e-commerce, retailer, or anything else, is really going to improve to a great extent your collection and make it not only work on the default rate, but also helps you with the collection cost. It makes the collection cost as minimum. So that will also allow you to lower your interest rate and become very competitive in markets where the interest rate is needed to be low to attract mass of the market.
Yeah. So really, really conscious design decisions, both from the internal operation side, but also reducing friction on the customer side as much as possible. Really interesting. Thank you. I'm going to change tack a little bit. And one of the things I wrote down that you just said is when you talk to regulators, you need to know what to say, how to say it, and when to say it. And I think that was a real nugget of advice. On the regulation in banking, oftentimes, central banks and other large institutions have to be a part of a financing conversation and a partnership that fintechs and companies that want to do embedded finance have to engage with. What's your advice to founders trying to partner with banks, for example, without getting absorbed or blocked? Because in most cases, these banks are the big gorillas, the fintechs are small upstarts. What's your advice in that regard?
I'll tell you what we see now. I mean, we see now in the last few years, I mean, and Egypt is an example, and I think is no different from other African countries, is that the regulators, mainly the central banks and the financial regulatory authorities, have realized that the advancement of the financial services, the advancement of the financial inclusion is highly dependent on the success of fintechs. So now this is an established fact. And as much as we saw a lot of, I would say, concerns from the regulator in the past decade is no longer here. I mean, most of the central banks, most of the regulators are very open, very welcoming for the startups who are going to really to help them to achieve their targets in terms of financial inclusion and digital payment. Saying that, some of the things needs to handle the relationship with banks, because banks are still keeps most of the money. They are the one who are providing financing. They have the license after all in many of the countries. So, however, also banks have realized throughout this number of years that we know now what they can do, what they cannot do. Banks are heavily regulated. This is a fact. No matter how good they are, how capable they are, because actually they have access to funding, they have access to the latest technology, they have everything. But because of the heavy regulation that is built around the banking industry that is everywhere, there is a limit to where they can go. So as much as you need the banks need the fintech. And the relation has to come in both ways. I mean, the fintechs can go to the bank, say, I'm not going to compete with you. I'm going to help you to achieve what you want. So one of this is offering your technology to the banks to address their clients. So banks normally have a decent retail network, retail customers that they can offer them their service. And they need the fintechs to help them with their technology, with their agility. And then the second part is saying to the bank, I can help you at the bank with your license, with your funding to reach a segment that was never possible to reach with the current banking challenge. So if you establish the win-win situation, I mean, ultimately, if you go and say to the bank, I'm going to compete on the customer base that you have, of course, you will have a very bad attitude. But this is should not be the case. I mean, I'm going to help you with my technology to address your customer. So I become a technology provider to the bank in that space. And I'm going to help you to acquire customer that the cost of serving this customer to the bank does not make sense. So if you build this complementary thing, most of the banks will be on board with you, because they ultimately looking for to achieve a target. And if you become part of this target, there is no friction. Of course, what I say is a bit idealistic. I mean, it cannot happen everywhere this way. But the more you find the common grounds, the better results you achieve with the banks. If you find yourself competing or selling your story as as a bank, you are not good enough, you cannot capture the opportunity, I'm going to do it on your behalf, and that's it, I think you are not going to go anywhere with the banks. So I feel it is more of building the win-win situation that helps each organization to achieve its target. The only thing, just to conclude again, banks now know very well what they can do, what they cannot do. So they have the flexibility to cooperate with fintechs.
So, Okasha, let me begin to move a little bit now back into the personal side of things. It's always easy to forget that we are all human and we are all on an entrepreneurial journey, which is testing. It has its highs and it has its lows. You work with lots of founders now, and you were a founder yourself, so you know that it can be depressing, it could be a lonely journey at times. When you reflect back a little bit on your journey, could you share perhaps, I'll start with a high. What was maybe a tipping point in Fowry where it made all the difference? And then also, if you can also share a low point, sometime that maybe you struggled and you had doubts and,
Okay. Good. I'll tell you, of course, it's very easy for me to tell you what's the high point of Fowry. I mean, finding myself standing in front of the bell in the ringing the bell in the IPO. That was a great moment, not only for us as founder of Fowry and the Fowry investors, but also for the whole ecosystem. We were the first tech company to be listed in the local stock exchange. I think I think across Africa, but I mean in Egypt, this was a special moment where finally a tech company is listed. And I think it opens the door for many of other companies to come after us and do great things in the ecosystem. So at that point, I can remember very well that I remember a low point when I was standing in that place. In 2012, 2000, I think in that year, I mean, we will have a tough macro position. I mean, revolution, currency devaluation, challenges in the whole environment in Egypt. And Fowry at that point in time was almost bankrupt, going to bankrupt. I mean, funding was very difficult, country was not stable, and we were almost running out of cash. I remember a point where we went to we tried to find a way to solve our cash flow problem, and we went to one of our vendors, one of our suppliers, that used to provide us with the supply us with a point of sale, the physical point of sale. And we told him a very nice thing. I mean, we are running out of cash, and we cannot continue. So we have two choices. I mean, we owe you money, and actually we will need more point of sale from you. So let's make a deal. We will get more point of sale from you, and we will have a bigger debt. But instead of paying that, we will convert it into an equity in Fowry. So instead of you losing the whole money, you will bet again on us again, and we will get out of this, hopefully, all winning. He was a very smart guy. He read it. I mean, if I said no, I will lose all my money. So if I said yes, I will take another smaller delta. Luckily enough, I mean, in 2 years from that position, I think 2.5 years exactly, he made almost 6x on his money. When we did a first exit, and he made a huge return. But that is a very low point. I mean, because maybe we would have stopped the journey at that point and everything would have collapsed. So I remember that when we were ringing the bell and say, wow, it was possible to go zero. And yeah, thanks God that we continued the journey and we reached that point. So I always remember these two scenarios. I mean, sometimes you have to be resilient, thinking out of the box, and believing in what you do, so you continue to fight until you reach what you dream of.
Yeah, it's really interesting. With our last guest, the high and the low happened almost together as well, and it's interesting to hear you talk about the high, but remembering the low at the same time. So thank you for sharing that with us. That was very nice. Before I start opening up to questions, you are an investor now. Presumably you raised some money while you were at Fowry. What advice or would you give founders as they try to build these fintechs in Africa around investment and raising money and dealing with investors?
Okay, I think there are many advice to give, but the one thing that always comes to mind is we are not in Silicon Valley. We are in Africa, and exit options is limited and will continue to be limited, and we are not going to be seeing 100 of unicorn in Africa very soon. So you have to come to that with a rationale. You have to realize that you need to be very capital efficient. So the name of the game, capital efficiency, means that you raise what you need and you spend what you have very wisely. because raising too much money sometimes is not good. Spending on non-essential items throughout the journey can expose you to run out of cash ahead of time. And we all agree that good companies do not fail because they lose money, but because they run out of cash. So cash flow and being efficient in capital is key.
Sound advice, back to basics, but the basics are fundamental. Thank you for that. Okay, so what I'm gonna do is shift a little bit to some questions from the audience. I'll read them out, Okasha, and then I'll let you answer one by one. The first question I have is from Tierno Ibrahima Diallo, who asks, you mentioned merchant rails as a key trust layer. In markets where cash is still dominant and informal commerce is large, how do you recommend onboarding merchants at scale without diluting the quality of the relationships? Is there a good quote unquote unit economics thresholds per merchant that we should target? That's a little long, but hopefully you got that.
I just want to make sure that I get the question. I mean, is it about the acquisition approach, or is it about the managing the relationship after the acquisition? So can you please repeat the question just to make sure that we get it right?
Yeah. The question is, in markets where cash is still dominant, how do you recommend onboarding merchants at scale without diluting the quality of the relationship? Is there good unit economics threshold per merchant that we should target? Yeah, I mean, if I were to interpret this as you scale, how do you keep that close relationship with each of your merchants? You know, it's different when you're working with 30,000 as opposed to 300,000 agents, for example.
Okay, I mean, the acquisition strategy changed from business to business, and it's different from a service to service. I mean, if you are offering them to become your agent, this is something. If you're offering them a terminal so they can use to accept payments, is different. If you are offering them or using them to sell a service on your behalf, that's a different thing. But in general, I think the approach is bringing a clear value to the merchant initially, and ensuring that you are focused on their channel their profitability as your channel is key. Because I mean, if you make sure that the business makes sense to them and they are making money out of that, or either even if you are selling them a terminal to do acceptance and you are taking a cut, but ultimately that will help them to generate more business. You continuously having them pulling the service, not rather than you pushing the service. And by pulling the service, that means your cost of acquisition will continue to be improving as you grow. The other thing I'd advise, I mean, it is very important for startups to continue to build on the brand. Building the service without focusing on the brand really deprive you from two things. One is that the cost of acquisition will continue to be high as you go, because sometimes when you build a brand and it's becoming very recognizable, that means that you get acquisition without having to spend too much on the next acquisition numbers. The second is, on every P&L of the companies that we look at, there are two things that we always say that we don't show in the P&L, but is very valuable: the brand and the technology. When I mean technology, I'm not talking about how good is the app. I mean the technology integrations with the other, especially in financial services, with the for example, with the network, with the certified body like the central banks, the Visa and the Mastercard and stuff like that. So it's very important to focus on the brand, because it will help you in many things, including the acquisition.
Very clear. So there's a question here on the rails or the technology, if I could paraphrase. This one is from John Waweru, and he was asking if you could just tell us a little bit about your experience building the rails that powered their technology, which I believe you were just alluding to.
Okay, let me tell you now what's the challenge. I mean, now the technology with the AI and happening with the AI revolution that we are seeing is becoming very easy, much easier and less cost effective. I mean, you can build a great technology, a great app, and great thing. But the one thing that's continue to be time consuming and will be defensible and very hard to replicate again is being integrated to the ecosystem. In each financial market, financial institutions in every market, there are certain integration that is needed for you to start operating and certification. So these things will continue to be time consuming. Integrating with the operator, integrating with the billers, integrating with the banks, integrating with all entities around you is the one thing that will continue to be time consuming and cost had a cost implication. So now it is not about how beautiful is your application, how good is your feature, how easy to use your application, which is something important, but this can be easily replicated. The one thing that's worth the money and worth the time is the integration with the whole ecosystem.
Interesting insight. Thank you. I have a question from Mike in London, and he says he'd like to hear a little bit about lessons learned in building partnerships with banks to provide balance sheet support for lending. And have you found that different from your time at Fowry versus now at Disrupt Tech with the companies that you invest in?
That's a very big challenge. I mean, that's why, I mean, even in Disrupt Tech, we are limiting our exposure as a portfolio to the balance sheet business. And as I said early, and maybe in this talk, is that we are now focused on two questions with these. How will you be able to raise local debt? Because there are a lot of good companies that manage to raise debt in foreign currency. This is not going to solve the problem. You need to be able to raise local debt from local institutions. And because banks are very traditional in offering lending, they need to certain requirements that most of the startups initially do not have. And even if they have, they will give you money, provide you with a line of credit or debt, much slower than what you need to grow. So one question is, would you be having a backing of a certain big organization or a certain, I would say, personal connection or certain political influence, whatever is the reason, the way to do it, to be able to have a local debt in a speed that is convenient for you to grow to achieve your plan. So that's one thing. The second thing is, do you have any special data that allows you to provide lending and profile customer and do credit scoring efficiently and cheaper than others? If you don't have either of those, I mean, I would say that the lending now as a business, as a balance sheet, is not favorable to most of the investors do not prefer to invest in early stage who started to offer lending without having either of these two question answered. Any advice? I mean, banks will continue to be very traditional in the way, and they have the right, because ultimately the startup failure rate is high. So they think, how can I lend an organization that is very new without having the proper collateral? And if you go to, there is still what we are missing in Africa is the venture debt options in local currency, very limited. And wherever I go, I try to say, let's work together as a whole ecosystem to provide the startup with an option for venture debt, because these are the only organizations who have the agility and capability to provide that to business like that. But in the absence or the very limited options of venture debt, and banks are unlikely to change in a very near future to offer lending to the startups in a different way. That's not going to change much. So balance sheet business has to be thought about twice.
So you mentioned special data as kind of one of the prerequisites. So I have a question here from Sanele from South Africa, who wants to know at what point, I guess this is probably in Fowry's journey, did you know that you had enough transaction data and trust with your merchants to make lending viable?
From day one, I mean, yes, I mean, I said from day one, kept on building data because we had the transactional daily data from every merchant that we have. And we developed our business intelligence tools to help us improve on that and use that for different things. But very late in the journey, also we understood very clearly in Fowry and other markets that other businesses is that data is not enough because we need to have the know-how how to lend, because part of the of us working with merchants in Egypt in the early days is that it's more of a trading business. So providing more of a supplier credit type of business is common, and it's not considered lending, but it's a way to learn more about the behavior of merchants. Once you move to a proper lending product, you need to get the right people who can build this business for you. You have to get the right licenses and the right regulatory approval to provide that, and to do it in the proper way, not to do it as a feature again, but do it as a core competency in a separate thing. So it happens, but it happened a bit later in the journey.
Okay, I have a couple more questions here. This one is from Matasabia, whom I recognize. Hi, Matasabia. She's in Ethiopia, and she asks, you mentioned that as you were onboarding merchants, or as you called them, human ATMs, one of the challenges was literacy. And Matasabia asks, what were some of the other challenges in the onboarding process and creating that initial network effect?
We did a survey a couple of years after we started operation to ask the merchant what is the reason, what's the biggest reason for you to have Fowry Terminal, I mean, in the store? Because Fowry Terminal was used initially in the first couple of years to sell airtime and to collect bill payment. By default, I mean, in Egypt, I don't know if this is different from many countries, but I think it is now common is that the margin on the commission on the airtime and bill payment is being pressured, and it is low. So compared to other products in the shop, in the pharmacy, in the kiosk, in the grocery, it is not comparable. So surprisingly, the first reason that the merchant said is that it brings me foothold. So sometimes you ignore the fact that this is not for them the core reason to make money, but if it brings customers that can buy other products from the store, so that's another interesting insight. So we kept on hammering on that selling point. I mean, we will add more services, so more people will come to your store, and in exchange for that, we are not going to focus too much on how much money you make. You'll make money, but you will make money from selling Fowry services and increasing the sales of other services in the store. So you become part of the whole. So that's another insight that you can add it to the journey that we learned from the journey of dealing with merchants. I think it is common to most of the African countries as well.
Okay, I have a couple of questions here that are a bit more macro. Alex Rugema asks, why did you not expand to other parts of Africa? I'm assuming this means as Fowry.
That's a good question. Actually, we had the 4 years or 4 or 5 years before the IPO, we always looked at where and how we can expand. Actually, maybe it was a mistake. I mean, maybe it was a mistake that we didn't expand in the right time, because at one point of time, Fowry was a great success story in Egypt, and everybody was looking up to it. So we would have been easy for us to expand to other markets where people would deal with you as coming from the States or coming from Europe with a great innovative solution. But again, when you are in a country like Egypt, very big market, the opportunities is endless. It's a choice. Either you focus or continue to focus on being the dominant, capture the opportunities and continue the gap between you and the competitors to widen, or to expand, because expansion again is another DNA, another culture change, another focus, and it is a distraction. You cannot do it without having the proper focus on it. So it was a choice, but you don't know. I don't know if it would have went well if we decided to expand maybe in the journey.
Yeah.
So it's a choice. I mean, we made the choice that we wanted to focus on the market. We were hit by the macro challenges, of course, during our journey. But if you are growing faster than the macro challenges, you still are creating value in the company as well. I wouldn't say that this is right or wrong. Some other companies took the other route and made it very well.
Yeah.
Again, if you are in a small country where the total opportunity is limited, of course, the expansion will be a top priority for you. But in countries like Egypt, Nigeria, South Africa, maybe you will think twice before you think to expand.
Interesting perspective. And yeah, as you strategize, the thing about strategy is you never know, there's no certainty, but you have to be strategic and you have to commit to a certain path. So interesting to hear that. I have a question here from Hamid, who's closer to you in Egypt. And the question is, given the lack of liquidity in Africa's public markets, why did you and Fowry choose to pursue an IPO rather than, for example, a merger or a strategic or an acquisition?
That's a good question. I mean, it's a risk that we took as well. I mean, we always had this discussion with, I mean, should we wait and list in London Stock Exchange, for example, or find an opportunity for an acquisition from a global or a regional player who come to acquire the whole company, or to take that risk? We believed that, okay, Fowry had at that point in time built a very, very strong brand. So sometimes when you go to a local stock exchange where the people, retail people in this market knows you very well, have used you very well, it makes it easier for them to take a decision that I know this, I know Fowry, I use it every day, so it's probably a good thing. So I'll put money behind it. So it was, again, another bit that works very well for us. And I think now, after the success of Fowry and other startups that followed us, now it is becoming on the agenda that local stock exchange is possible. Because people came to the stock exchange of Egypt to invest in Fowry because they like it. So if you have a good product, sometimes it is not bad, because the good product is important than the good market.
Great. We're coming up to time, Okasha, and there's one question that I always like to finish on, which is, if you were able to give all of us here on the call a gift that you can leave us with, this could be a book that you read, a tool that you use, a piece of advice, whatever you think that you can share with us on this topic, what might it be?
Okay. And I wanted to choose something that we invested in a company that is launching next week. This company is a very interesting model. It's a global, by the way, product. It's called Sinai AI.ai. Sinai, SINAI.ai. This company is building a very innovative product that allows you to interact with the books in a different way. So it changed the way people are consuming books. So it's an AI company for sure, and it is changing the way people deal with the books. So it makes the books as if it's talking to you. So you can talk to the book, ask about the author opinion. So it generates a different experience. So it's a platform for books. It's not one book, but it has many books from many publishers across the globe, and also allows you to hear the book in the language that you want, in the sound, in the voice of whoever you prepare. So it's a different experience. So I kindly ask you to try it and tell me what do you think about it. I think it is a game changer in that space.
Yeah. Thank you, Okosha. Really, really interesting. And thank you so much for spending your afternoon with us. Lots of nuggets and insights and inspiration that I've gained from the conversation with you. I'm sure many other people on the call have also done the same. So thank you very much for spending the afternoon with us, and we appreciate everything.
Thank you, Adam, for having me, and really enjoyed it as well. Thank you.
Great. Well, thank you everybody for joining another really interesting conversation. I ran out of space on the little piece of paper that I was trying to write down insights as I was hearing them. I hope you did the same. Just very quickly, we have a couple more sessions like this that are going to be taking place over the next few weeks. The next one is really interesting. It's in the space of stablecoins in Africa. We're going to be speaking with Holly Jones, I'm sorry, from Circle. And once again, thank you for being with us and giving your time to listen to our speaker today. Take care. I'll see you next time.
Thank you for joining us for EmFi, Embedded Finance in Africa. To watch future conversations with founders, operators, and investors shaping financial services across Africa, follow Renew Capital on LinkedIn, YouTube, and your preferred podcast platform. We'll see you next time.